great to be with you all, and thank you for joining our Family Office CIO panel. And thank you very much to the folks at Global Alts for putting this wonderful event together and wonderful panelists that we have. My favorite part of any conference is the engaging with peers, and we have a great group of peers of you all here up at the stage, and we're going to walk through a bunch of topics that are top of mind to everybody here today. And before we get started, I'd like to go down the line and have everybody introduce a little bit about themselves, your organizations, any unique attributes of the family office or goals that you have for everybody. Jenny, let's start with you.
Hi, everyone. Jenny Heller. I've been the CIO at Brandywine for about 13 years now, and we are a client-owned multifamily office with about $16 billion in assets. We've been around since the early 90s. I guess being client-owned is somewhat unique. Two of our largest families founded the family office and are still the majority owners. And we're also a trust company, so over 90% of our assets are held in trust. We are the actual trustees over those assets. And what that really means is we have an extremely sticky capital base, long-term horizon. We rarely take on new families, so we've had about the same 15 families for many, many years. And we do pool their assets. We look a little bit like a taxable endowment into a couple of very simple vehicles. So it makes my job as an investor pretty pure, and that's something I love about it.
Bei?
Hi, good morning. I'm Bei Saville. I'm the CIO for Advance. It's a New York-based single-family enterprise and family office. The family has been in New York as a media family for 100 years, and we still have operating assets held in the holding company structure. And on the financial investment side, it's much more diversified globally, managed more like endowment model. So through that, we invest primarily via funds. At the same time, we work very closely with our trusted partners to engage in longer-term, meaningful opportunities for long-term investments.
Good morning, everyone. Matt Hershey. I'm the CIO of Marin Capital, the family office for Donald B. Marin and his family, financial services and private equity legacy. Don was the chairman and CEO of Payne Weber and the founder of Lightyear Capital. We follow a more or less typical endowment style approach. We'll also do some directs, being a US-based family, a little more probably tax aware. But generally speaking, that's the model we like to follow.
Good morning. I'm Sid Malhotra, Chief Investment Officer and co-founder of Cactus Capital. I've been there about 10 and a half years. It's a single-family office for a private equity executive. We invest across public and private markets. Contrarian to what most people would think, we actually invest extensively in private markets, even though the principal made his money in private equity and still runs a private equity firm. I've been in the family office space since 2008, so seen a good amount of evolution in the space.
Great. So I'd like to start with a topic that is very relevant to everybody in this room, and we are all feeling with it, which is the lack of distributions in private markets. I think that the last 10 years plus, we're dealing with some challenging distributions that are near decade lows. Averages the last couple of years are 50% below longer-term averages. Some will say this is opportunity, and some will say this is a challenge with lack of distributions. Family offices tend to have a longer duration of capital than most out there. Jenny, if I could start with you, how are you navigating today's private market environment with the lack of distributions that are taking place across private equity and venture capital?
Sure. We've really coached our families for a long time to commit about the same amount to private equity every year so that we don't get big up and down swings, which has allowed us to be relatively steady. We also effected a secondary sale about 5 years ago of some of our tail assets, which has just kept our distribution profile a little bit more balanced. But it's still challenging in this environment, and it's an opportunity. I think it's a really interesting time to lean into managers that may have been access constrained who are now finding that it's a little bit harder to fundraise, especially managers that tend to have a longer distribution profile, like on the venture side, have to be really, really careful on the underwriting side of it, thinking about quality of returns, because often you're underwriting marks as opposed to DPI. So ensuring that you really understand what those marks are and if it's multiple expansion or if people are actually underwriting to real organic revenue and EBITDA growth matters a lot. And we've also, we've been looking around to see if we can pick up managers that are already in our portfolio, perhaps at discounts on the secondary market. Haven't had as much luck there as I'd like, but we're still looking. But we have invested at the margin in some vehicles that are looking for sort of zombie funds with single asset opportunities at the tail end of their life where they can restructure maybe the GP carry and underwrite to really, really attractive returns by taking advantage of the fact that there's just a lot of GPs that are trying desperately to get rid of tail end assets. So I think we've seen opportunities at the margin. I'm a little more skeptical of the secondary opportunity set as a whole, but I think there's bits and pieces around the margin that are really interesting.
Thank you, Jenny. Matt, would you add on to this in terms of where you're seeing opportunities and how you're thinking about the lack of distributions across private equity?
Sure. I think Jenny makes a great point that now is an opportunity where you can partner with certain managers who previously might have been more difficult to access because so many folks are slowing down their commitments to private equity or venture capital. And so if you have the ability to commit, interesting sort of opportunities and investments can avail themselves. The other thing that I think this period sort of highlights, which is interesting, is everyone focuses on how much of the book is in private assets, but no one talks about unfunded commitments and liabilities. And at least for us, we like to have a steady pacing to PE, but we run with a pretty conservative unfunded balance such that we never feel like we can't continue to commit. And I think as a rule of thumb, it's probably always better to err on the conservative side. Otherwise, you might have a significant amount of your portfolio in privates, but then you're also looking down the barrel of a big unfunded liability that will have to be called from you at some point, further exacerbating the problem unless you see distributions. Therein lies the opportunity, I think, to partner with groups, when others have to step back, if you run more conservatively, which is what we prefer to do.
Thank you. Related, let's talk a little bit about where we're spending our investment research and capital deployment. Bei, I'd love to start with you on that, where you're spending your time deploying capital. What are you looking for today?
Yeah, just back on the points that Jenny and Matt just talked about, there's definitely a disconnect between public and the market space. There are several things we're looking at. Obviously, everything is priced very well. So one of the advantages of being a family office is really the long investment horizon and also unique aspect in specific sectors. I would just name a few. One thing, everyone talk about AI quite a bit, but AI is just a name. Underneath, there's a huge, tremendous growth, both from the depths in terms of scientific research, what actually will propel this evolution to continue. There are multiple ways that a family office actually can continue to invest and benefit from this very long tail of growth. And also from application side, we see more deep broadening of application. But again, have to be aware of who you partner with, whether they really have unique access, and how do they think about the partners they're working with. So that's one area we spend a lot of time working with the network that we have built conviction over time. And secondly, it's an area that has been lost interest from public market for various reasons, particularly more recently because of policy uncertainty, that is life science. I have been a long-term positive cheerleader for the life science, and I do believe in the conjuncture of scientific discovery, demographic trends. This is a great area and a lot of low-hanging fruit because of this disconnect between the scientific development new drug development, robotics, so many different things. So that's another area that we spend a lot of time. And other things like the future of labor, that's sort of in conjunction between what's happening with AI and globally what happened in the demographic trends and labor movement. Actually, the tariff and all of the capital flows create interesting dynamic in how global companies are rethinking even in their labor force. So maybe there are unintended consequences while we're trying to bring back manufacturing job, but we're actually losing some more higher value add jobs. It's only the beginning. When we talk to the C-suites, decision makers, there's some very interesting conversation going on across even in the US companies, not even mention global companies. So that's another area we're spending time to understand. And then there are a lot of idiosyncratic opportunities. With that, primarily we rely on our managers that has really much deeper and faster respondents than we can make. So we work with them to make those allocation and the choices. Just during the past merely 2 months period, some of our managers really not just wait and see, but actually lean in based on their deep research. And we do have, to Matt's points about make sure you have a more cautious and scenario testing of your uncalled capital. Make sure you do have some capital on the sideline to lean in this opportunity.
Thank you. And Sid, same question to you. And I know that there aren't a lot of inexpensive assets. We're getting paid to cash levels, and yields are pretty attractive to be waiting. Where are you seeing opportunities that you're getting excited about that get over that bar today?
Yeah, I think there's sort of two areas. Within credit, sort of playing on a little bit of a derivative of the secondary opportunity is, NAV lending. So we really like that space. We've actually been investing there since 2017, before it was, more of a household name. And right now, the opportunity set there is very, very attractive from our perspective. You can get loans right now where there's unlevered yields of, call it 11%, and you might get no idea of 1 to 1.5%. If you're with a manager that uses leverage, your return's going to be even higher. But we really like that space a lot, just given that companies were bought at much higher valuations. They are over-levered, and they need a little bit more time to grow into these valuations or hit business plans, so they're going to be held longer. They're fully tapped out from a financing standpoint. Sponsors don't necessarily want to put in more equity. Co-investors don't want to put in more equity, and so whereas a release valve in terms of bringing in more capital, it's a NAV loan. And so we're happy to be that provider, because when you provide this capital, the loan is basically collateralized by every other asset in the private equity fund. And so I was looking through one of the portfolios today, just to give you an example. A loan to a portfolio company A is collateralized by, let's just say, 12 other companies in that fund. So it's over collateralized like 20 times that loan, and so it's very hard to lose money. Basically, the only way you lose money is if every portfolio company was fraudulent and worth zero. There's all these covenants, and so I hate to say it's impossible to lose money, but it's pretty darn impossible to lose money. So I think it's one of the best risk-reward opportunities out there, period. And then from an absolute return perspective, it's obviously, from my perspective, uber compelling, because they're making a 12 to 13% unlevered return. That's not IRR, that's real return, like yield. And so that's pretty compelling from my perspective. And again, that's senior in the cap structure. They're getting paid first. And the weighted average tenor of these loans is 4.5 to 5 years. The only negative is you can sometimes get taken out quickly after a year or two, so there is reinvestment risk, but it's not a bad situation to be in. So the negative of it is when times get good, it's a little bit hard to deploy the strategy, but it is a nice counter-cyclical strategy, especially in times like today, for all those attributes. Another area that we like in general today and just always, we call it sort of an all-weather strategy for us, is lower middle market private equity. There's a lot of different definitions on how people define that. We define that as companies that are sub 10 million of EBITDA when you buy them. So, companies that are, 1 to 10 million of EBITDA, you can still buy them today for, 6, maybe 7 times EBITDA, and that's, real EBITDA, not adjusted pro forma BS EBITDA. It's real, and then you can do add-ons. We're sort of buying them down, with 5 times add-ons and sort of grow them organically, inorganically, and you can usually do those add-ons for free, just with leverage, and you sort of grow these companies, and then you sort of sell them upstream to a bigger private equity player. And so we like to call it internally manufacturing product for bigger private equity sponsors, and we kind of view it as a trade where you're basically making product for middle market private equity firms, and the capital is there, so these companies are going to get bought. And so we love it because it's a trade where there's a natural buyer, and there's so many of these companies out there, and they're so fragmented, and it's sort of like if you have kids, it's like the giving tree. It's like the tree that keeps giving. So we love that space.
Matt, anything that you would add on to?
We've, for the last few years, been spending a lot of time in real assets, both oil and gas and energy, starting 3 or 4 years ago, as well as real estate. The way we like to think about it is, capital floods into a space, returns get compressed, they're not as good as you would have thought, companies don't perform as well, capital leaves, and that's a much more interesting time for us to get involved. That's certainly been the case in the oil patch, given the last sort of cycle, and sort of the larger institutional allocators who can't invest in there or won't invest there anymore. Again, going back to what we were saying a moment ago, managers who are absolutely fantastic operators are now sort of open to business with new capital partners, and those have been very fruitful investments and just great conversations. And then on the real estate side, we see it as well with more loans maturing, cap rates up, LTVs down. There are lots of folks who are caught between a rock and a hard place, and we believe over the next several years you'll just see more of that getting recognized as people can't extend and amend their loans anymore, and eventually the bill comes due. And we've seen some really compelling opportunities starting in office, but we think it'll move to multifamily, student housing, and other areas as the bite of higher interest rates and lower values continues to take shape. More contrarian, it's not sexy like an AI investment, let's say, but or super interesting, but you can find some really compelling yield and returns, we think, in real assets right now.
Thank you. And a lot of people in this room and across our investment community have been debating and thinking a lot about, are we at an inflection point of US versus the rest of the world in terms of investment opportunities? Jenny, if I could have you start this one off, how do you think about investing globally versus the US in marginal capital today?
The US has been an extraordinary place to invest for, forever, but certainly for the past 15, 20 years. And we've had to fight the battle to stay global. I still think it's extraordinarily important to have a global mindset, even if we have a US dominant portfolio. And I think especially now, if we look at, 36 trillion in US debt, 120% debt to GDP in the US, foreign holders of US debt have been declining since 2008. For the first time, we're seeing, even with US bond yields going up, the dollar isn't strengthening. US valuations are stretched relative to the rest of the world. And in our own portfolio, take our global equity portfolio, which is US dominant, we managed to outperform the S&P last year, largely because, our US companies did well, but actually it was our companies in China and India that were really driving meaningful returns for us. So the way I've coached my families on this issue is to think about being global as an insurance policy. If you own the ACWI, you will still be 65, 70% US. And if the US continues to work, the ACWI is just going to become more of a US index. That's a good and a bad thing, but it means that the cost of that insurance policy is relatively low. We're also seeing that markets are decorrelating at the margin. That's a trend that we've seen in the last couple of years. So in some ways, you're getting more of the diversification that it didn't feel like we were getting for a long time, and at least this year, that's moving in the right direction. I love the US. It is the majority of our portfolio, but it's felt really, really good to lean into diversification in a market where I think US policies are being viewed with a lot of uncertainty. Interestingly, I just had a manager call me the other day and tell me that their European investors no longer wanted to invest in the US, and this is an extraordinarily strong manager, one of our highest conviction private equity funds. Their European investors didn't want to invest in the US companies in their portfolio because they're concerned about revenge tax and because, frankly, they're just angry. And they were going to create a Euro share class and only invest in the European part of their portfolio. I've heard the same from some Canadian CEOs recently. So it's just it's an awkward time for the US. And I think all we can say with certainty is that it's a highly uncertain moment. So to me, it's a really good time to stay global.
Thank you, Jenny. And I love how you put the global as an insurance policy as an interesting point. Sid, perhaps taking the US perspective, sharing some of your views, which may make that same point.
Yeah, no, I fully respect Jenny's views and appreciate them. I think we have a little bit of a different view. We definitely have more of a home country bias, and maybe it's a little bit, Warren Buffett-esque for whatever reason, don't bet against the U.S. We have never done anything in China, and everyone thought we were crazy. We thought people were crazy. It's been the right call. I just think of a Venn diagram framework and just think about the U.S. It's the best capital markets, the deepest capital markets. So the best companies anywhere are going to want to list in the U.S. So that's a reason to be invested in the U.S. markets. The biggest and best companies, whether it's the Mag 7 or whatever, are going to continue to grow in the U.S. and abroad, and they're listed in the U.S. The best educated people are in the U.S. The most productive and driven and ambitious workers are in the U.S. I just think about the best place to just be an entrepreneur and just grow and do what you want is in the U.S. So if I just think about Venn diagrams and where things overlap the most and the highest probability of just being successful as an economy, it's just the U.S. And then if you own a company or a business and you want to grow it, the U.S. is just a massive country, and it's just easy to grow your company if it's in the middle of Ohio or New York to California or Hawaii or Alaska. There's no regulations. If you're in the UK, you can't really grow to Europe because you're not part of the EU. It's like a totally different world. Or if it's like, you know what I mean? If it's like Italy and you're trying to run France, like, yes, it's the EU, but like it's two different cultures and languages. It's like a little bit different, or you know what I mean? Or Europe to Asia. So I just think there's benefits in the US that are a little bit maybe misappreciated. And while the currency may fluctuate, it's still going to stay the reserve currency for a very long time. These things take forever to unanchor. I don't think the renminbi is ever going to be the world currency. It's a communist country. They can just shut the gates whenever they want, and people keep forgetting that until they get reminded. And it's very, very brutal when they get reminded. So that's not happening. The euro, I think, is very tough because it's just a ton of different countries. So it's like, how do you peg that? And so I just think the U.S. is like one of the best places to bet, but you need to be cautious. So we do it a few different ways. There's absolute return hedge funds that are long and short, so you're not betting directionally. There's lower middle market private equity, where it's very, very different. It's not really a beta bet on the market. It's just growth of lower small companies, right? And you're sort of betting on bigger private equity companies gobbling up these businesses. So that's a very different bet. And so we sort of play it like very, very differently than just like a directional beta bet of like large cap stocks just going up. I think that's very kind of one-sided, naive. We don't really do it that way, but I still just think the U.S. is the best place. If you go abroad and you ask anyone like, where do you want your kids to go to college? Like the U.S. And where would you probably want them to work? The U.S. Unless they have like a business that their kids could take over, or you know what I mean, or they're very, very wealthy. It always comes back to the U.S. And you ask them why. It's like it's the place where there's the most opportunity. If they can start a business, it's the highest odds. Like I don't think that's changing anytime soon.
Thank you, Sid. And if there was one country, briefly, that you would allocate incremental capital to outside the U.S., what would it be?
Yeah, so we are looking at Japan, and that's more on the buyout side. I think the opportunities for buyouts in Japan are pretty compelling from a financing perspective. The arbitrage is great. Rates are extremely low in terms of base rates. Like 1%, and then if you just think about the spread to finance it, it's very, very low. equity valuations are low, so you can take private a lot of these companies, sort of clean up the governance, make the companies a lot more efficient, and then relist them or maybe sell it to a bigger private equity firm. So I think there's just a lot of opportunity there. People talk a little bit more about the public equity opportunity set, but I think it's much, from my opinion, more compelling on the private side, just because you can sort of expedite everything that everyone's talking about in terms of the public equity opportunity set if you take the company private, because you can do whatever you want and you can lever your investment to juice up the return.
Thank you. Now I want to shift gears to the GP-LP relationship. And maybe it's evolved from general partner, limited partner to general partner, strategic partner. And it was earlier that it was discussed that it's been a challenging environment for raising capital, and you've seen a lot of evolution that's taken place with relationships between GPs and LPs, with co-investments early on, co-underwriting investment opportunities. You're seeing things like seeding more firms and their funds, or even taking outright stake. Bei, if I could have you start by addressing how have your relationships with GPs evolved over the years?
Sure. So, again, at family office, one of the advantages is really our value proposition and holding horizon. So it's perpetual, strategic, and really creating a partnership with experts. So that's really our value proposition. Through that, we work with a very small group of GPs, cultivate that relationship, trying to get in early to understand for mutually what we would like, the sectors, the size, maturity of the companies, and create an environment where we can add to the GP as a value-add investor. Not just a LP passive or some sort of filtered, passive filtered co-investor. So previously, I was at more of an endowment foundations background. I think a lot of people are doing more of a co-investment, sort of trying to do 50-50 co-investment and fund investments, which is fantastic. But I think at where we are today, that relationship, at least from my perspective, has changed much deeper, where you can actually leverage your unique edge to create opportunity for both GP and the LPs to win. And that, for me, is one of the areas I think that we can actually lean in together with our GPs in area where not a lot of the upside. Maybe the story are not, people have different opinions where this company's growth strategy, the TAM can be, where the operational improvement or some of the growth strategies can be. But we have, as a long-term investor, and work with the GPs and the management companies that build that conviction.
Jenny, anything you would add to that?
I think we have experimented with almost every type of GP-LP partnership I can think of over the years, from fund of ones to anchoring funds with advantage terms, to co-investment relationships, to just regular way investing. And I don't know that that's changed in this environment. We're always looking for creative ways to partner. I would say I'm very mindful of investing with an emerging manager in an advantaged way where a substantial piece of their capital base, especially in a liquid format, I think it can make the exit really, really complicated. So it's not something we won't do, but I'm just very mindful that it's much more than a partnership. You're really entering a marriage with someone, and you will be a big part of the dialogue if you get to an exit point, even 5, 6, 7, 8 years later. I just experienced this, is do they have enough of a business built around us that we're not going to end their business? Because if you end up ending someone's business relationship, that is something really heavy to bear. And I think on the private side, it's a little easier just because you have duration. So it's something that we love to do. We don't stake. I think for us, we felt that it's fundamentally misaligned. I would rather have terms that accrue to every early investor that are more sort of, where more LPs can benefit from it, and also where I think it's more aligned with them not raising too much capital over time, because that's what we tend to like to see.
Thank you. Well, Jenny, Bei, Matt, Sid, you are leaders in our industry, and we really thank you for spending time and sharing your insights. So thank you very much. Appreciate it.